Hi guys, David Jenyns here from davidjenyns.com. I've just put together a short presentation for my private coaching clients to talk them through what's going on currently in the financial markets around the world. Everybody seems to be getting caught up in the hysteria, and I think it's important that we take a step back and have a look at what's really going on. I open up the slides with the Chicken Little story here. Now the sky is falling. For those of you who don't know much about the story, the basic premise is this chicken goes off to get his hair cut, and on the way home an acorn falls on his head and he thinks that the sky is falling, so he goes around telling all of his friends. Now there is some different endings to the story, but the moral is always the same, and that's don't believe everything that you hear. And I think that's hugely applicable in the current climate at the moment. So let's take a look at what went wrong with the whole subprime crisis that we're faced at the moment. I suppose it all started when people really started to spend a lot more and consume a lot more than they should have. In the States particularly, there was just massive overconsumption and huge overspending, people spending way beyond their means. They were taking longer holidays, buying bigger cars, getting newer houses, and just living extravagant lifestyles, taking on huge amounts of debt, much more than they ever should have. And this was fueled by the US having a huge property boom. The values of property all over the States was going up, and just like any boom, typically that turns into a bubble, and then when the bubble bursts, that's when people get caught. And this property boom was no different. The problem with a boom as it inevitably sort of morphs into a bubble that's going to burst is you've got this hysteria surrounding the market, and people start to think, oh, this property boom is going to go on for ages, or this boom is going to go on for ages, and you hear people throw around the terms, but this time is different. When you compare that to, some bubbles we've had in the past, even just recently, if you look as recent ago as in the 2000s when we had the internet bubble, and we had the same situation where valuations were just rocketing through the roof, way past realistic valuations of what that underlying asset was worth. And that's what happened in this property boom. You've got people who were buying houses and the way they were funding this increased lifestyle and massive consumption was to revalue their house at further down the track to pull some money out of the house to help fund that lifestyle. Now, that all works well and good once property prices are rising, but once they start to fall, that's when things come unstuck. It's just not a very stable model to grow on. And people thought, but this time was different, and we've never seen property prices go down before, so they were lulled into this idea that as long as the repayments they were making on that loan were lower than the increased value that the property went up by, they were in front. And that's how they justified it with the property boom. Now, obviously, the money still needed to go back to the end user, and where did that money come from? And this is why Wall Street has been given much of the blame as to what's going on or had gone on. Now, I think multiple parties are to blame. You can't just pick any one particular person and say they are at fault for what happened. But the way a lot of this growth was funded and the money getting given back to the consumer who probably shouldn't have been taking on this debt was because of this massive growth and companies listed on the Wall Street Stock Exchange, banks and things like that. They were creating new assets or new securities that would lump together a lot of these mortgages that people had into a new security, listing that on the stock exchange. And you've probably heard the term mortgage-backed securities, and what that's referring to is these securities backed by the mortgages, and they were getting listed on the stock exchange. People were investing into the market, and thinking that these assets were secure because they were mortgage backed, and that's where a lot of that extra money came from. Unfortunately, now the situation we're faced is where the honeymoon period is over. People really did take on too much debt, and a big part of that was everybody got a lot more relaxed in their lending criteria, and you had the introduction of things like low doc loans, where someone who probably shouldn't have been able to borrow money was enabled to borrow money because, you know, the property boom was so fantastic and people just wanted more money to fuel that growth there. So the introduction of low doc loans, a loan where an individual can effectively, with low documentation, just write how much income they were making with no proof, and were able to get these loans typically at a higher interest rate, but they were happy to take on that higher interest rate because of the property boom, and they were sold this idea that no, it'll be fine, you know, all you have to do is wait a few more years and look at the way property growth is going. All you have to do is refinance your house. You can pull the money back out and then continue to fund your lifestyle that way. So people really did take on a lot more debt than they should have, and I think some of the blame needs to be put onto those mortgage brokers as well, who were selling people on the idea of taking a lot more debt than they should have, and then that again falls back to Wall Street as well, enabling and allowing this to go ahead. The result was that banks, many businesses were hugely over leveraged. Now, leverage is fantastic, but it is a two-edged sword. On the way up, it helps you create a lot more money than you probably would have because you leverage in. You've got access to more money than you probably should. But on the way down, it means you'll lose your shirt twice as quick because of that leverage. So leverage can be good and it can be bad, but in times of huge growth and especially in bubbles, people take on, you know, extra leverage, thinking that they want to take advantage of that. There was also the introduction of, and I think this really did play a big part in the crisis where we're at now, the introduction of new and exotic derivatives. Derivative is just a product that derives its price from an underlying security and typically is very leveraged. Now, new and exotic ones were coming out where people didn't fully understand the risks involved, and they didn't fully understand what the derivative product was actually doing. And I think not that ignorance is ever an excuse, but if you look at some of the companies on the Wall Street Stock Exchange, a lot of them didn't necessarily understand the risks they were taking on board. And through the use of these derivative products, because they were so exotic and no one really knew how to value these derivatives as such, when it came to putting it on balance sheets and reporting your profits and things like that, it really did create a little bit of an opening there for people to overvalue those assets without really having an understanding of what risks there were. And if you look at some of the collapses we had Bear Stearns and we had Fannie Mae. Now, Bear Stearns was leveraged into mortgages 30-1. So basically, they had 30 times as much debt as they did have backed by assets. Fannie Mae's even more ridiculous. It was leveraged 129-1. And a lot of that was because of the derivative products which enabled that to happen.